Unless you're paying with cash, or you can buy at an exceptional price, or you have great credit, or you have a solid, reliable source of income, or you're being forced to move through relocation, death, or divorce, or have a great loan assistance program so you don't have to break the bank, or you're planning to live in your new home 7 to 10 years, or a combination of any of these things, don't buy a house. What? Did a real estate agent really say that? Oh yes, he did. Look, I'm gonna let the cat out of the bag. Real estate is a hot mess right now. Real estate brokerages are now looking at thinner profit margins in 2023 due to anticipated lower production from agents. Mortgage lenders are looking at fewer mortgage applications this year and next due to higher interest rates, and people in ancillary industries are either getting out of the business or are thinking about it. And if they're not getting out of the business, they're coming after you to try to get you to buy a home. It's a great time to buy. There's less competition, there's more inventory, interest rates are going down in 2023.
Lies. Oh, lies!
Seriously, all of those things, except the part about interest rates, are true. In many ways, the current market is much better for buyers than it was even just a few months ago. Higher interest rates have pushed many buyers out of the market, at least for now, and many of those folks are just waiting in the wings until either interest rates or home prices or both come down. And if that's you, let me know in the comment section below. And home affordability, which has become a serious issue across the whole country, is especially challenging when you're having to choose between paying a huge monthly mortgage payment or paying for eggs, milk, and bread in the grocery store. I get it, but I'm here to tell you that now is not a good time to buy unless you have a clear reason for doing so and you have a solid financial footing before you make one of the biggest financial decisions of your life. Hi, this is Robert C. Baker with United Real Estate Experts, and on this channel, Move to Chattanooga, we talk about all things related to real estate in the greater Chattanooga, Tennessee area and beyond. And if you don't mind, go ahead and click that like button, subscribe to the channel, and hit that notification bell so that you'll know when there's new content for you to view. Now, maybe you just won the lottery, you paid off all your bills and have $500,000 to spend, or maybe $5 million. You've never owned a house, but you always wanted to buy one, so go ahead. Or maybe your family has just become larger and you don't have enough room and you're looking for a place where your kids and your fur babies can stretch out and grow. Or maybe you're at the point of retirement and you've got a great credit score and a goodly amount of retirement income, so you're thinking about living in a place in the country you've never lived before. Or maybe you're just starting out and student loans are not a serious issue, you've got a good stable job and a profitable side hustle like YouTube star. Or maybe you just qualified for a loan assistance program that's going to pay for all your closing costs, and so you're not going to be financially strapped when you walk into your brand new home. There are hundreds, if not thousands, of reasons why a person or family might want to buy a home in this current real estate market and be in an excellent position to do so. But in this video, I'm going to talk to you about 3 things you need to think about before buying a home either now or in 2023. We'll take a look at where jobs, interest rates, and home prices may be going in the future. And be sure to stay tuned because I'll share a bonus at the end of the video. And by the end of the video, you'll be better prepared to think about your own personal or family situation and make a wise choice about buying a home now or in the coming year. So let's get started. First, jobs. Business Insider recently reported that top CEOs of major U.S. companies and even foreign companies are predicting a rough 2023. What are they concerned about? They're concerned about a recession. In fact, 91% of U.S. CEOs believe that there will be a recession within the next 12 months, at least according to a recent KPMG survey. And what does that mean? It means that you can anticipate layoffs in some sectors, work slowdowns, and reduced hours. Because those things may affect your income, they may directly impact your ability to buy a home. Now, trying to increase unemployment isn't something that you would expect the government to do, but with high inflation, that's exactly what the U.S. Federal Reserve is hoping for by jacking up the Fed funds rate and by liquidating their balance sheet. They're trying to kill inflation. Well, not kill it entirely, just to bring it down to 2%. In fact, the Fed is betting on people losing their jobs and has already baked in rising unemployment into their projections released at the most recent FOMC meeting. Just how many folks will lose their jobs? That remains to be seen. Right now, however, the Fed is not getting the numbers it wants. Employment figures keep improving, which is a good thing for workers, but is contrary to what the Fed is looking for. So, if job security is an issue that you're wrestling with right now, or you're worried about money, think long and hard before you buy a home, at least in the current market. Second, interest rates. Multiple articles suggest that the Fed is not going to lower the Fed funds rate or ease back on quantitative tightening. That is, so long as inflation runs at 40-year highs. We discussed in a previous this video how the CPI, the Consumer Price Index, including core inflation, and PPI, the Producer Price Index, are awful, so check out that video next. In fact, some Fed members have taken, at least publicly, a hardline approach. Philadelphia Federal Reserve Bank President Patrick Harker is one member saying that the Fed will not back off until it gets the job done. "We are going to keep raising rates for a while," Harker remarked. That said, a recent article from the Wall Street Journal, let's call it a trial balloon, hinted that the Fed may start slowing down. Not stop hiking the Fed funds rate, but raise it by fewer basis points. Most people believe that the Fed will raise the Fed funds rate 75 basis points at its November meeting. But the scuttlebutt is that the U.S. Central Bank may calm things down a bit by raising the rate only 50 basis points at its December meeting. As you can see here, that's already being baked into the predictions where the Fed might go. It's not certain yet. These are only speculations by Fed watchers about where rates will go, but some folks are thinking there may be a slowdown coming in December. And while you know from watching this channel that the U.S. Fed funds rate does not directly impact mortgage interest rates, the rate does factor into the overall economy, which does impact mortgage interest rates. However, right now, there's no direct, irrefutable evidence that the Fed is going to change course. And if you're thinking about buying a home either now or sometime in the future, keep a check on the U.S. Fed funds rate. While the relationship between the Fed funds rate and the 30-year mortgage interest rate could change, for the past 40 years, the 30-year has always been above the Fed funds rate, which means that whenever the Fed funds rate goes up, you're pretty much assured that the 30-year mortgage interest rate will too. So if you see in the news that the Fed is raising the Fed funds rate, you can be pretty much assured that based on 40 years of data, that the 30-year mortgage interest rate is going to go up as well. Or you can just keep watching the 10-year Treasury, since the 30-year runs an average of about 2 to 2.5% above it. Third, home prices. Some locations in the country are seeing home price reductions. In fact, the pace of home price reductions is going up. That said, even in areas where there have been some price reductions, home values are still outstripping wages, and wages are not keeping up with inflation. Take a look at this chart from our friends at Realtor.com. Here we learn a number of things. First, the number of active listings is going up, which is a good thing for buyers. That's the green arrow. And by the way, these are year-over-year figures. However, part of the reason we're seeing an increase in the number of listings is because they're staying on the market longer. You can see the median days on the market between the green and blue arrows, and the percentage figure right next to the blue arrow. And third, you can see how over the past couple of months that year-over-year price reductions have been going up. That's good news. It means that sellers and their agents are getting more realistic about the current market and are taking the current economic situation seriously. That said, prices are still high in most areas of the U.S., which certainly impacts affordability, and for many folks, the current real estate market has not reached a point where a home is within their reach. Stay tuned, because a side effect of rising interest rates is home prices going down, because sellers who want to sell will have to lower their prices in order to attract a buyer. And here's your bonus. Let's talk a bit about the myth that a primary residence is an investment. I hear folks saying that their house is an investment, and it kind of makes me, well, a little bit nervous. Some authors such as Robert Kiyosaki will say that a primary residence is not even an asset, but my college accounting teacher would beg to differ. A primary residence is an asset, but unless you're renting it out, like a room or a basement or mother-in-law suite, presuming you still live there, it is not an income-producing asset. A home also has fixed and variable costs associated with it. If you own a home, you've got to pay principal and interest payments on your loan, if you have one, and you've got to pay taxes, insurance, upkeep, and repairs, and so on. But you're not making any money on your home, at least until you sell it. Because you can sell it and convert the home into a more liquid asset like cash, a home is an asset, at least according to my college accounting professor. But it's not an income-producing asset, so thinking conservatively, it's not an investment. Selling a home during a recession can be very tricky. Want some tips? Watch this video next.